Welcome, everyone. Thank you for tuning in to the webinar. We're going to get underway here in just a moment, but we want to give folks an opportunity to sign in and to tune in as it is a live event. And we're going to cover lots in this webinar. We've got a lot of details specifically gained at taxes in retirement. What are the basic items? What are the tax traps we often see? How do you avoid those common tax traps? What are some tax credits we think retirees should be thinking about to ensure that they do claim? We've got that and so much more to cover here tonight, Kevin. But as you know, I can't get too far into any webinar without keeping the lawyers happy, so we have to pull this up on the screen.
Exactly.
I'll move it over here so we can see the disclaimer. And we will cover everything I mentioned tonight and more. Adam Buss will be doing the presentation for us in just a moment, but we have to put the disclaimer on the screen here so you can see all the nuances, all the details there that the compliance folks want us to see. And I did mention Adam Buss, Kevin, and he's going to be doing the presentation for us tonight.
Yeah, we do appreciate you showing up for this. And Adam Buss is our wealth and estate planning specialist, and he will be doing our presentation tonight. And we want to make sure that we let you know exactly what's going on. So if you have any questions, please do type them into the comments section, and Adam will get to them while we can. We're going to let him finish the points that he's talking about first before introducing those. And if they don't get said right during the presentation, we are doing question and answer at the end of this webinar, and Adam will get to as many questions as we can. Please feel free to type as many of those into it, and we'll get to as many as we can. But without further ado, we will introduce you to Adam Buss.
Yeah, and it is the comment section that Kevin was mentioning there. So you type it into the comment section on YouTube so we can see those questions. And with that, we'll let you take it away, Adam.
Yeah, make sure to fill in lots of questions. I plan to keep Kevin from watching the hockey game for as long as absolutely possible. So by all means, type lots of questions. I hope to cover a lot of valuable information for you this evening. And let's jump right in. So as I mentioned, I'm Adam Buss, the Wealth and Estate Planning Specialist here on the Becker Orr team. And it's my job and my pleasure to be here tonight and present some great information for you. So retirement income sources. So what choices do you have when it comes to different sources for your retirement income? Often asked, where is my money going to come from in retirement? How much am I going to get? When will it all start? When should I take CPP? When should I take old age security? How much am I going to get from all of these different sources? And how do they all work together to create that cash flow for me in retirement time? So we're here to help address those questions for you. Now, different sources of retirement income that you have available. So first off, there's some government programs. So if you haven't noticed in the financial world, we do love acronyms. So let's start off with CPP, which is the Canada Pension Plan, and OAS, which is the Old Age Security. Further to that, you have your own resources. So RSP and RRIF, so Registered Retirement Savings Plan, Registered Retirement Income Fund. We'll dive into all of these a bit more in depth as we go along. Then you have your employer's plans, so defined benefit pension or defined contribution pension plan. You have your own additional savings sources, perhaps it's income from a non-registered investment account. Maybe you have a corporation, you're getting dividends and salary perhaps in retirement time. You have the option of annuity income. You might still be working part-time or full-time in retirement. A lot of people tend to take on different roles in retirement. Perhaps it's a passion project, or perhaps it's just something to keep themselves out of trouble. And then there's additional non-taxable sources that you can draw from in retirement. So TFSA, tax-free savings account. It is an extremely valuable account that we want to see clients take advantage of for the rest of their lifetime. Just because you're retired, it doesn't mean you can't keep putting money aside into this plan. And of course, there's accessing cash value in life insurance policies, which is a bit more complex, but again, another source of funds that you can access in retirement. So let's go through some of these a little bit more. So Canada Pension Plan and Old Age Security. These are income sources in retirement that are paid towards the end of each month. I believe it's around the 28th or so, or 3 business days roughly before the end of the month. I'm a few years away from collecting on that, but I'll be sure to let you know in the future. Certainly you could ask Kevin. I'm sure he's creeping up to that point in time soon. Optional withholding tax. So unlike when you're employed and your employer is taking off taxes on a regular basis, you have the option to ask Canada Pension Plan or Old Age Security to take taxes off. Now, what happens if there isn't taxes taken off? Well, we'll chat about that later on. How is my CPP benefit determined? Great question. This is a very common question that we get asked, which is, what am I going to get for Canada Pension Plan? Well, this program is designed as a contributory plan, which means you get based on what you've put into the plan. So if you haven't been working your entire career up until the point of retirement, you're likely not going to get anything, or not very much at the very least. If you've worked the entire time, it depends how many years you've contributed the maximum to the Canada Pension Plan. Everybody does have a different amount that they're going to receive up until the maximum. So these are different things that you want to look at. Old age security is a bit more of a set dollar amount, and that is based on how long you've been in Canada. So as long as you've been in Canada since the age of 18 all the way up until the point of retirement, at least 40 years. 40 years would be the maximizing time period. And of course, again, what is withholding tax? That is, again, taking some tax off. So when you go and file your taxes, you don't have a big nasty bill that you have to pay come April when you're filing your taxes. Speaking of which, that is coming up here in just over a month or two. Now, how much does taking my CPP early or later affect my income? Again, probably one of the most popular questions that I get asked when I'm building financial plans for clients is, how much am I going to get for CPP? When is the right time to take it? The answer is, I don't know. Like, there's no right answer that fits for everybody. So certainly don't feel like you should be guilty by taking it early or by deferring it. It's, what do you feel is the right choice for you? There's always a dollars and cents component of this, and where is the sweet spot? Where am I going to maximize my benefit? And it's all fine and dandy as long as you live until certain points in time where you will know for sure that you're going to maximize your Canada Pension Plan benefit. So let's go through some of the numbers here. So there is, of course, maximums at various ages. So if you do take CPP as early as age 60, which is the earliest you can take it, you do get a reduced amount. So you actually get 36% less by taking it at age 60 versus age 65. So if you see here on the chart, it says maximum monthly amount, $917.12 is the max you could get at age 60 if you're entitled to that. And of course, there will be the averages as well. So not everybody gets the maximum. The average person at age 60 is only getting about $517 a month. At age 65, the maximum, we'll call this the normal age for starting point, is $1,433. And the average, again, is about $808 a month that people are getting. And now if we go to the far extreme, all the way till age 70, you actually get a deferral bonus. So you actually get 42% more by pushing that benefit all the way out till age 70. And that's just over $2,000 a month. Now, all of these benefits that you see on the screen are indexed to inflation, and they do go up with the cost of living on an annual basis. Now, of course, there is no right answer. There's no wrong answer when it comes to taking Canada Pension Plan. Do you need the money is certainly a big thing. What is your health like? What are your financial needs like? What's your income level? And what's your personal outlook perhaps on life expectancy? And again, this is a plan that you've put money into throughout your working career. And some people want to take it out as soon as they're able to. So again, trying to pick what is the right choice for you. Now, old age security, that one you can only start as early as age 65. So you cannot start that one as early as age 60, only at 65. Now, the standard amount, provided you've been in Canada for 40 years and meet the requirements, is about $727 at age 65. Now, that is continued that way all the way up till age 74. And then there's a little boosted amount after age 75 in the OAS amount. Now, OAS, old age security, you have the option to defer this benefit all the way up till age 70, in which case you do get, again, an increased bonus for deferring that benefit. And now you'd get $989 at age 70, moving on for the rest of your lifetime. Other factors to consider. Oh, yes, there is no survivor's benefit. So if you pass away prior to collecting the funds, you're not going to get anything. Your survivor's not going to take anything over. For Canada Pension Plan, there is a survivorship component. So if you leave a surviving spouse behind, they could be entitled to a portion of your benefit up to the maximum that one person is generally entitled to receive. The calculation is a bit more complicated, so certainly one of those things you'd want to do some more research on based on your scenario. Now, this is an interesting one, and perhaps I'm just a bit of a numbers geek, and that's okay. That's my job. But it's trying to calculate your lifetime loss. Now, a couple of years ago, Financial Planning Canada put out a study. Now, if you're really bored one day and you want to read it, it's, I think, about 80 pages of super dry information, but it's going through and trying to say, what is my lost benefit from the Canada Pension Plan if I take it at 60 versus 65, or 60 versus 70, or even 65 versus 70, and trying to quantify and say, how much money are you leaving on the table if you wait, or if you start too soon? So if we look at some baseline assumptions here, somebody's getting the maximum amount at all these various ages. What does it look like? Okay, so if we just pick a point in time and say, let's look at the very bottom where it says starting at age 60 versus age 70. Let's say, again, a male client would have a life expectancy average at 86, and let's say a female client would have at age 89. If you're drawing the benefit at 60 versus waiting until 70, you're leaving about $130,000 to $150,000 on the table and not getting that income throughout your lifetime. So it's quite a substantial amount when you calculate your lost benefit that you would have been entitled to had you started a little bit later. Now that's in today's dollars equivalency. Obviously, with cost of living, things tend to get more expensive. These are inflation protected benefits. So if we look at your future dollars lost, it's between $200,000 to $300,000 of lost income. Now, again, this is a calculation making some assumptions on life expectancy. And if you know exactly how long you're going to live for, it would make my job a lot easier trying to calculate what is your optimal time to take this benefit. Now, most people generally don't know this information. So again, we have to make some assumptions, and it really depends what makes sense for you, which is why we build this into the financial plan and want to look at what is the right choice based on your set of parameters, based on your income needs, to figure out what is an optimal time, again, from purely a dollar standpoint, to take the benefit. So again, those are things you want to look at. The other things people always ask is, what is the break even? What's the crossover time period, essentially, when I would have been better off waiting to take my benefit versus anything else? So if we look at, if you start at age 60 versus 65, the approximate crossover age is about 73. So you technically would have been better waiting till 65 if you live past age 73. And if we look to the extreme between starting at 65 and 70, the break even is approximately age 81. So again, break evens are purely a rule of thumb. That is not the end all and be all when it comes to trying to calculate what is the right choice for you. All right, another source of income is a defined benefit pension plan. So if you're so lucky as to have one of these options through your employer, how a defined benefit pension plan works is it's a guaranteed specific monthly amount of retirement income for the rest of your lifetime. It's a formula essentially to determine what your benefit is. It's typically an annual income of yours pre-retirement, or it's an average of the past years. How many years of service did you work for the company? What was your contribution amounts? And then there's also a formula saying, it's X amount times your income times years of service. Again, these can be a bit more complex if you want them to, but again, those would be things to look at. And that's our job, to help calculate and make sure that you understand what those benefits would be. Another important factor is your pension indexed, or is it adjusted to COLA, so cost of living adjustment, which means, is your pension keeping up with inflationary pressures as you do go through retirement? Additional options that some pensions have. Apparently my lights go out when I'm not moving in my office. There we go. Is bridge benefits. So it'll get adjusted so you can take a higher amount early. So it's also called integration with Canada Pension Plan and Old Age Security. And the design of that is typically give you a higher amount from your pension up front until you start Old Age Security and CPP, and then they reduce your pension thereafter. Other considerations that you want to do is the penalty. So an early retirement penalty. So some pensions do penalize you fairly heavily for retiring earlier. So that's where we really want to look at your pension benefits booklet and understand, what are the parameters? Is there a magic rule of 80, or is there a certain retirement age that you have to hit to avoid a reduction? Another one is survivor options. So what portion of your pension that you've worked so hard for and put all this money into throughout your career is going to go to your surviving spouse? The standard is typically 2/3 of your pension to the surviving spouse. Some pensions, the standard is 50%. And then some pensions also give you the option to transfer 100% to the surviving spouse, which means the income doesn't stop when you pass away. Other options may include things like a guarantee period. So perhaps you don't have a surviving spouse, but you want to make sure something goes to your children or whoever else is important to you. So you'd have an option to have a guarantee period where that income would continue or a lump sum would get paid out to your desired beneficiaries. I know Clinton's joined. It looks like I'm done on my slide. A couple more things here to go through, and then we'll get to likely a question. So again, always check with your pension provider, get a detailed statement as to what you might expect at retirement time. All this information is hugely valuable. Examples of defined benefit pension plan could include things like Health Employees Pension Plan here in Manitoba. We call it HEP, the Teachers Retirement Fund. So we go TRAF, Government of Canada pension plans, Province of Manitoba, Manitoba Hydro. I will take one other quick example here. So even though it's a guaranteed pension, there's still no guarantee that that pension value couldn't change along the way. And all of this goes based on the actuarial calculations behind the scenes to determine, is there enough pot of money invested in that pension plan to continue to fund the obligations moving forward? So one example from the past was a Sears pension. So obviously Sears had some financial difficulties, went out of business. At that time, their pension was technically only 88% funded. So those wonderful people and dedicated employees that were there for all of those years and have already been retired, their pension dropped by 12% just because there wasn't enough money in the fund. So even though it's guaranteed as much as there is funding behind the scenes to pay for it. All right, Clinton, I see you've joined. I'll let you jump in now.
Sure. And a reminder, please do type your questions in as we go. We might answer them in the comment section. We had one a little earlier and we simply typed the response right in the comment section, or we can ask it like we are now. And the question is more to do about indexing. It's a question we often get for clients, kind of a twofold one. One is, how common is indexing for defined benefit pensions? And then kind of a second part is, indexing is not a be-all, end-all. There's lots of versions of it, full indexing versus partial indexing, all that type of idea.
Great question. And part of this actually goes to my next slide, which is really good timing. And I don't think it's planned that way. So really good job on the timing of the question. So I would say a lot of the pensions are at least partially indexed. There's not very many of them that are fully indexed. And some of them also have a cap on the indexing level. So it'll be, we'll do full indexing or do partial indexing up into a maximum amount. Some pensions will also index on what I call an ad hoc basis. They say they'll do it, but it's only if they have the money available and the pension board approves an additional distribution for cost of living adjustment or indexing. Very common that pensions are indexed to half of inflation, 2/3 of inflation, maybe full inflation. Again, every pension is going to be slightly different, which is where we really want to understand how that's worded within the pension documents and what is the history of that employer actually paying cost of living.
Excellent. Thank you. And please do
Excellent.
keep typing the questions
Yeah,
into the comments
keep
as
the
we go
questions
here.
coming. All right. So as I did mention, there is certainly an example here of purchasing power erosion over time. So I have an example here. A client, an individual, has expenses of $24,000 a year. Of course, expenses don't care if what your pension is indexed. It's going to continue to go up with cost of living changes over time, and things do tend to only get more expenses, as I'm sure everybody on here is very well aware in the most recent years. So again, expenses are continuing to rise year after year, regardless. So let's look at two different pensions here. So I was very kind and picked two different shades of blue. So again, you'll have to differentiate between those there. The red line is the expenses. So you'll see expenses trending upwards year after year. In the early years, both pensions appear to be sufficient for covering the expenses. But obviously, pension one, which is the light blue, stays the exact same the entire time. So you will notice that over time, there's quite a gap that grows between the income coming in and the expenses that have to go out. So if you are not adjusted to inflation or only partially adjusted to inflation, you have to obviously come up with additional resources to make up for those expenses. So that's where, even though you're in a good position that you have a defined benefit pension plan, that may not be sufficient for all of your needs. Okay, so even though you have a defined benefit pension plan, you do want to save some additional funds for either, again, keeping up with inflation or just increased discretionary spending as you go throughout retirement. Just like today, you may have paycheck to paycheck where you're covering expenses. In retirement, you will get that paycheck, but in between those, we might need some other resources that you want to spend and enjoy, or perhaps go on that trip on an annual basis. All right, now if we go to the flip side, so more common these days, I'm going to say, is a defined contribution pension. And the reason I'm going to say it's more common, it's easier for employers to set up, and it's also less costly for them to set up as an ongoing liability. It's essentially functions like an RSP. Okay, it is an RSP where the employee typically contributes and the employer typically contributes, and it's often a percentage. Now, I'll give some generalities, which is usually in the, let's say, 3 to 5% range for most employers that they are putting in, and they are matching your contributions. So if Clinton was putting into his defined contribution plan at 5%, his employer might be matching that full 5%. Now, sometimes the employers are only going to match part of your contributions, or they might exceed how much you're putting in there. Again, every plan is going to be slightly different, but that obviously is, again, a benefit for you as an employee and helps enhance the amount that you have available as a retirement resources. So it may not be a guaranteed pension income stream, but this will form a pot of money that you can draw from in retirement, much like an RSP or a TFSA or other resources. Employers additionally match a portion of employee contributions. Your employer does not control where the contributions are invested. So again, typically with any of these group plans that are set up, you're going to get a list of 5 to 30 different investment options to select as to how you want to put this money in the investments, and obviously subject to the investment risk that ensues. But again, it is just an investment product, what you put in versus how much it's going to grow over time. Now, when you leave your employer, these plans can be consolidated with your favorite investment advisor, who may or may not be on this call, more than likely is, but Kevin and Clinton could certainly help you out with consolidating the accounts. And then we look at, typically converting it to a LIRA, an RSP, or RRIF, or you can use that cash to purchase an annuity. And again, just to create that income stream in retirement time. So whether you have a defined contribution pension plan or a defined benefit pension plan, those are also both eating up your RSP contribution room on an annual basis. So keep that in mind when you are trying to determine how much you can contribute to an RSP. Most people with a good defined benefit pension plan typically don't get much RSP contribution room because their pension plan is using a lot of that room behind the scenes. All right, contribution limits. So for 2024 tax year, so of course you have the deadline coming up here in the near future, is $31,560 is the maximum contribution. So there is some historical numbers here, including TFSA limits, which are $7,000 a year. If you've never contributed to a TFSA, you can contribute up to $102,000, provided you've met the requirements the entire time frame. How is RSP room determined? It is 18% of your prior year's earned income. So earned income is the key here. Now, as an example, easy math, make my life easy at this time of night, $100,000 salary times 18% equals $18,000 of RSP contribution room. So if you're not sure, look at your notice of assessment, go to your MyCRA online and find out, because the penalties for over contributing to any of these options are far too painful. So certainly don't encourage that. And when in doubt, double check what your room is. Okay. How does this change with dividend income, investment income? People often think that just because you have the income coming in, that it's generating this pile of RSP contribution room. That is incorrect. Pension income, dividend income, investment income, none of that is generating RSP contribution room for you. It has to be earned income. Okay, so those are things that we do want to look at when trying to calculate what your contribution room might be. And a common question we get is, I'm approaching retirement, or I am retired. I have, $50,000 of RSP room. Should I use it? Well, more than likely not, right? Especially if you are retired, your income level is going to be consistent. It might not make sense to use that room that you've accumulated throughout the years. But again, this is just general advice. So certainly have a look based on your situation at what makes the most sense. Lira and LIF. So locked in retirement account. Kevin, I see you're jumping in. Do you want me to finish this slide or?
Yeah, finish some of your slide and then I'll get to the question that's coming up.
All right, sounds good. So locked in retirement account. So this is essentially money that came from a defined contribution pension plan. So basically the province, each province has different rules, sets legislative requirements that they're trying to make this money last for your entire retirement. They don't want you just to go and cash it all in and buy a Ferrari tomorrow, right? So they want to make this money last so that way you have money in retirement time. That's the whole point of it. When we convert an account from a Lira to a LIF, that's where we are taking the drawdown out of the account moving forward. So Lira is essentially the deposit style product, and a LIF is the withdrawal side of the product. Okay, locked in, again, that's just pension restrictions. Every province has their own restrictions. How do I unlock my Lira? Well, obviously you want to chat with your advisor and see what the options are. For the most part, again, it changes by province, so I won't get into the specifics here, but some provinces do let you unlock 50%, some let you unlock 100%, some are only if you have other financial hardships or other parameters. So again, if you're not sure, double check with your advisor. Kevin, you got some questions?
So, yeah, LIFs, you mentioned that they can be divided into something else now. Is there a big difference between provincial ones and federal ones, or?
You mean for unlocking rules?
Yes.
So as an example, I'll give you one because I don't have all of the provinces memorized, believe it or not. But Manitoba lets you unlock 50% of your Lira after the age of 55. So that is basically just removing restrictions on half of the money. Okay. So it's not like you can cash, you're taking it all as income in particular. It just means that they're removing the pension restrictions. Okay. At age 65 in Manitoba, they allow you to unlock 100% of that amount of money. Now, the only thing unlocking does is it just frees up the flexibility. It puts you in more control as to how and when you want to take out the money. Okay. It's not going to change the taxes, nothing like that. It's just going to make it a little bit easier to slowly draw down that account.
Perfect.
Excellent. Thanks. All right, Registered Retirement Income Fund, or RRIF. So what is a RRIF? It is the account you convert your RSP to. So just like there is a LIRA and a LIF, and if you're still with me after all of these acronyms, that's great. A RRIF is the withdrawal product of an RSP. Okay, now you have to convert your RSPs. Every last penny of your RSPs has to be converted to a RRIF by the end of the year you turn 71. And then the following year, you now have to take out a minimum payment on an annual basis. That minimum payment does change on a sliding scale over time as a percentage of the account. So if we look at age 72 as an example, 5.4%. So if you have $100,000 in the account, $5,400 is your minimum payment that you have to take out and pay tax on an annual basis. Okay, so that is a thing to be aware of, and it's basically the government's way of saying you've had this money tax sheltered all this time. We want you to start taking some money out and paying tax on it. Okay, now you do have the option to convert it earlier than age 71, and often that's a proactive approach that we're going to look at for clients, is saying, well, let's start taking some cash out a little bit sooner and really controlling that tax rate that we're going to pay. There is no tax necessarily automatically held on the withdrawals. It does depend. So if you're taking out a minimum payment only, we do not have to take any taxes off. If you're taking over and above the minimum payment, we have to follow the standard CRA set rules when it comes to withholding tax. But again, anything over and above that, certainly chat with your advisor to see what makes the most sense. A common question is, I have to take out all of my RSPs by the age of 71. That is incorrect. You do not have to go and cash everything out before you're 71. The rule is you have to convert it to a RRIF and then at least start slowly taking some cash out. Okay. Now, what investment options do I have for a RRIF? Well, everything you can do inside the RSP, you should be able to do inside the RRIF. Again, if you have concerns as to what the investment strategy is, certainly chat with your advisor. But basically, when you convert RSP to a RRIF, the four letters on the account change. That's it. That's the only change you're going to see essentially. Other account options in retirement is non-registered account. So this is an account that is after-tax money that is already invested, and you're going to pay tax based on any income that was generated within that account. Perhaps it's generating interest, dividends, capital gains. You're going to pay tax on those on an annual basis. Withdrawals are not taxed. It's essentially your money being returned to you, and you're taxed based solely on the investment income and the characteristics of that investment income. The other thing, there is no tax being withheld on interest and dividends and capital gains. So if you have a lot of non-registered income that's generated because Clinton and Kevin did an unreal job for you, well, now you have to pay tax on that amount of money when you file your taxes. So these are things that we do want to consider when we're looking at income planning for the entire year. Why is this a useful account? It certainly is just another pot of money that you can draw from. And that's the important thing. We want to have many different types of pots of money that you can draw from in order to fund your retirement and really help control that overall tax bracket. Speaking of taxes and tax optimization, everybody's favorite subject. Hopefully it's not coincidence that people tune out and go to the hockey game at this point in time when we're talking about taxes. I won't take it too personally. But what is withholding tax? So again, we chatted about it. Your employer today has to take off tax. They're mandated to take off tax from your employment income. Is it the same for retirement income? Again, it really depends on the type of income being generated. We've chatted about withholding taxes on RRIFs. We've chatted about withholding tax requirements on CPP and OAS. Again, these are things that you may want to consider. Everybody loves a refund and everybody hates getting a tax bill. Nobody likes having to write the CRA a big nasty check when they file their tax return. So is minimizing withholding tax a good idea? Well, yes and no. Again, do you want to get a big tax bill? The key is to not get a big refund and to not get a big tax bill either, right? It's all a bit of a balancing act. And usually your first year or so of retirement is really kind of understanding all your different income sources and make sure that the right amount of tax is ideally taken off so you don't get a nasty bill that you have to deal with. because that may lead you to the problem of tax installments. So if you owe too much income tax, I believe it's over $3,000 in springtime, then they will put you on installments, which means every quarter you're supposed to pay a preset amount to CRA as a way to hope that you don't have a tax bill owing come tax time for the following year. Now, what are some strategies to pay less tax? There is no silver bullet. There's no one size fits all. There's no way or scheme that we can try to get this down to zero. I try to be good, but I'm not that good that I can eliminate your tax bill entirely. Okay, so there are some things that we do want to look at. Income splitting, CPP sharing, RSP drawdown, using TFSA as a non-registered account, sheltering some additional cash inside of a whole life policy, charitable donations, trying to make your investments tax efficient. And then there's options such as a prescribed rate loan to a spouse or a trust. There's also RSP meltdown, which sounds similar to drawdown, but it's also completely different. But there is lots of options out there, and it's a matter of looking at your particular set of circumstances and saying what makes the most sense that we can keep more money in your pocket so you can go and enjoy your retirement time and not have to worry about paying a huge tax bill on an annual basis. So let's chat about income splitting and eligible income. I've chatted about this, I think, on many presentations because it is important, right? We do want to look at, in retirement, can we have both spouses in a very similar tax bracket overall? We want to try to manage your tax bill by keeping both of you in a very similar tax bracket. Now, before the age of 65, only money coming from a defined benefit pension plan qualifies for income splitting. Anything coming out of RSPs, RRIFs, LIFs, all of those things are taxed to the individual who's taking the money out. After age 65, it doesn't really matter who in the couple is taking the funds out of the account. It should qualify for income splitting as long as it's from a RRIF or LIF or LRIF, all these different withdrawal style products, because that's pension income. If you're just taking money out of an RSP, that is not considered pension income and won't qualify for income splitting. So these are little different nuances that we do want to look at when we're kind of planning for your retirement income stream. Income splitting, spousal RSPs. Some people think that this is a thing of the past. The whole idea of a spousal RSP is ideally to equalize the retirement assets. It's a proactive way of doing income splitting among spouses. Now, typically, the best way to use this account is the higher earning, the higher income spouse is the one contributing to their spouse or partner's RSP account as a spousal plan. So we'll use an example of Bob and Sue. Bob, in this case, is the lower income earner. Sue is the higher income earner. Sue contributes to Bob's RSP as a spousal contribution. Sue gets the tax credit today. Bob gets to take that money out in retirement as he's the owner of the account. Now, especially if we're starting withdrawals prior to the age of 65, that's really important that we want both spouses to have accounts that we can take money out of in equal amounts as a way of doing proactive income splitting. So again, keep in mind the contribution limits. So in the case of Bob and Sue, any contributions as a spousal contribution are using Sue's RSP limit. Bob could have $1 million of RSP room. It doesn't matter because it's using Sue's limit in this particular case. So those would be things to be aware of. We also do want to be mindful of what's called the 3-year attribution rule, which determines who the money is taxable to when it is withdrawn. CPP sharing. So again, this is another way of trying to do some proactive income splitting. So this only really applies when you apply for Canada Pension Plan, and it goes based on the time frame that you've been married and how much of the income can qualify for splitting. And this is done at source. This is not done on your tax return like any other pension income splitting. It is just done by filling out a form for Canada Pension Plan. So again, if that applies to you, something to look at. RSP drawdown strategy. we do want to look at what is the most logical order to draw down and access the funds in retirement time. Again, what is the tax bracket you're in today? How might that change in retirement time? And ideally, what is the optimal tax brackets that we're trying to stick to within the planning process, okay? So again, the theme here is to have a plan in place and make sure that we have a good understanding as to what you want to do for drawdown and what makes the absolute most sense. So let's look at a quick example when it comes to managing tax brackets. So example, so you have $90,000 a year of income. It's probably going to be consistent for the rest of your lifetime, so you're in a good position overall. Does it make sense to draw extra from your RSP? In this case, the example, the tax bracket in Manitoba is $57,000 to $101,000 at 33%. So essentially, you could take extra money, let's call it $11,200 out of your RSP, and the tax rate is going to be 33%. So most people, that makes sense to take out that extra income, control what amount of tax you're paying, and put it aside into the TFSA or a non-registered account for a future year or to reduce your estate tax burden later on in life. Okay. And again, if you're married, you have the option to do this with both spouses. The one thing that we're not considering in this is what the impact would be on old age security clawback, which would be another factor. Okay. Again, where are you going to put this money? TFSA, non-registered, tax-exempt, whole life insurance policy. These are things we're going to look at. And of course, you have the option to defer this extra income. You're not forced to take the extra income necessarily out of the RSP, but we're trying to be proactive, use two spouses tax brackets to access the funds and slowly filter it out to another account, and certainly trying to prevent leaving a very large tax bill on the estate side of things. RSP meltdown strategy. I won't spend too much time on this one because it's more complex and certainly a lot more conversation that we should have with a client. The concept is using a loan, an investment eligible loan, to zero out the RSP income to kind of wash that away and try to save as much tax as possible. There's a lot of different nuances and parameters that we do want to consider when doing this. And obviously, anytime there is leveraged investing, borrowing money to invest, there is a higher degree of risk that you owe this money on the debt regardless of what's happening on the investments. So this is one of those things that we really want to have an in-depth conversation with the clients to make sure that it fits their risk profile.
Yeah, I was just going to jump in there, Adam, to reiterate that same point, because I have seen other promotions for this type of strategy, and they normally highlight the tax benefit, and there are tax perks. That's why it's worth knowing it's out there, but you always got to make sure the priorities are accurate. You need to have a goal in mind, a plan to achieve that goal, make sure you're comfortable with the risk level of your portfolio. Then you get to the tax optimization bit. You don't want to put the tax before everything else and then up in a very high risk strategy you're not comfortable with. So just need to keep that in mind when you're considering this type of leveraged meltdown strategy.
Any other question, or you just wanted reinforcements to highlight the risk?
I was just highlighting the risk. So we did a couple of questions in the comment section, which we've been answering as they've come in, which is fantastic.
Marvelous.
Keep typing them. And I imagine we'll have a few more as we progress here.
Perfect. And we'll have a question period at the end for anything that we missed that we can certainly address yet. All right, carrying on. So using a TFSA or non-registered account as a lever account, I alluded to this earlier. The whole point of having, again, these different pots of funds that we can pull from is trying to control your tax bracket, or perhaps you have an expense in retirement or you want to gift some money to the kids. You have another account that you can draw from, which isn't going to impact your income level, right? So rather than having to withdraw an extra lump sum from your RSP and perhaps push you into a higher tax bracket or into old age security clawback territory, again, this just gives you additional options to access funds in a very tax efficient manner. Typically, we are trying to defer TFSA funds for as long as possible, but again, it is another account that you can use at your disposal. Common tax traps. So one thing we always want to look at is OAS clawback. So old age security is an income tested benefit, which means that if you make too much money in retirement, you do get some or all of your old age security taken away from you. Now, this doesn't sound like any fun, but it really is a good problem to have. It means you're making too much money in retirement, at least according to the CRA. It may not feel like you're making too much money, but again, there is very few Canadians that do have this problem overall. I think it's less than 5% of those drawing old age security have a full or partial clawback. So it's not a huge percentage. It does start at about $93,000 a year of income. Now, this is per individual. So that's $186,000 a year as a couple that you can earn without having to worry too much about clawback. And then you'll see it's fully clawed back at about $150,000. So those would be things that we do want to look at when we're trying to control what you have for taxable income. A big trap is certainly failing to have a withdrawal plan, or really just not planning in advance for retirement and really trying to map out where is my money coming from. And again, what is that logical order that when I want to take funds out of? Letting your average tax rate fluctuate. So again, really trying to keep it consistent as much as we can, and certainly not taking advantage of income splitting opportunities, which might even just be as simple of not knowing which account we need to take the money from or which spouse we need to take the money from to create that cash flow for you. Things you want to look at, obviously, is tax credits. I'm always a big believer in take whatever credits you can get and that you're eligible for. Don't want to leave money on the table. So there's age amount, pension income tax credit, disability tax credit, caregiver, medical expenses, home accessibility tax credit, and there's more beyond this, but these would be some that might apply to the retirement side. The pension tax credit is not necessarily just free money. It is the first $2,000 of eligible pension income is eligible for a 15% tax credit. So again, you might be in a 30 or 40% tax bracket. You're getting a credit for essentially the first 15%. All right, budget management in retirement time. We call it the retirement smile because expenses do tend to start at a higher level as we're enjoying retirement. We're more active, we're traveling. Some people also call it the go-go phase of retirement time. So expenses tend to start a little high. And then as travel perhaps weans off or maybe some discretionary spending goes away, there you will see a dip typically in retirement spending. That's called the slow go phase. And then there's often the no-go phase where perhaps some care costs or healthcare expenses tend to rise. So perhaps your retirement spending does tend to go up, hence the retirement smile. Important things to look at, and especially when it comes to retirement planning, is your budget. What amount of money do you need? It doesn't matter what amount of money I need or what I think you need to live in retirement. It's what do you envision your retirement looks like, and what is that going to cost you? So what are your goals? What are you going to do with all your newfound free time? Are you traveling the world? Are you picking up some sort of expensive hobby? All those different things that we want to look at in making sure what does your retirement look like so that we can help you achieve what your goal is. Is your budget realistic for your financial situation? Okay, so again, there's no standard rule of thumb how much you should have as a cash flow in retirement. It's what is your budget? What amount of money do you want to spend, right? That is a very important driver to know what your retirement's going to look like and that you don't have to worry about all the details. You can just go and enjoy and spend the money, okay? And that's what we want. We want you just to enjoy retirement and not worry about all the financial details that ensue along with that. Let us worry about those problems for you. Throughout the planning process, I'll certainly tell you what is possible for your retirement. How much could you spend based on all the parameters, everything that we've set up? But I don't know if that number is right for your retirement. You're the only one that can know that in determining how much money do you actually want to spend so that you can enjoy your dream retirement that you've worked so hard for. We are nearing the end here, so bear with me. Insurance needs do not stop at retirement time. So you do want to look at Do you have the right coverage in place? Do you have term life insurance to make sure still that the survivor is okay, or to make sure any debt is looked after? Do you have estate goals or tax optimization that we want to look at? We'll typically use a tax exempt whole life policy as a way to either shelter additional earnings to grow the wealth tax free, or use it as a way to leave a guaranteed legacy down the road. Other policies that you may hold pre-retirement is critical illness, disability insurance. Some of those policies do come with a return of premium rider, which means you get your money back if you don't make a claim or if you meet certain conditions. So again, that might be some money you're entitled to, so you'd want to check those things out. When you are leaving your employer, you would want to look at your health and dental insurance options if you want to carry that on in retirement time. You generally have 60 days to transition to your own plan without having to go through the medical underwriting process. Travel insurance, don't leave home without it. Long-term care insurance, again, if that's something that you want to explore the options for, we can certainly look at that for you. And all right, so nearing the end here. So financial planning, that is my job, that is my passion, that is what I do for clients. I want to make sure that I help you identify and achieve what your goals are. Again, we want to create an overall comprehensive view of your financial situation, where you're at today and where you want to go, which is why we call it a roadmap, right? It's the GPS lady yelling at you in your car, except it's me, Kevin, and Clinton trying to kindly guide you in the right direction towards your retirement goals instead. Okay, we want to look at all the opportunities that present themselves based on your set of circumstances and give you a good action plan to move forward as you go into retirement time. And that leads us off to question time. I did have a note here as well, just to say how great Kevin and Clinton are. So I'm not sure who put that note in there. I'm pretty sure it was them. But again,
It
if
is.
you do have questions, certainly reach out to Kevin and Clinton. They're amazing. They're very passionate about what they do on both looking after their clients and the investment management side.
Yeah, appreciate that, Adam. And please we'll hold on a moment here so you can type in a question in the comment section while everyone is on the line here. Or if you don't want to type it in and you want to do it outside of that, you, of course, can either contact us directly or go to chatwithclintonandkevin.com. That's part of our website. You fill in the little formula that comes directly to Kevin and I, does not go to a junior associate or anything like that. And you can also communicate with us through that form as well. We are getting lots of folks saying thank you, an informative webinar. So I think that means you did a great job there, Adam. Lots of good information.
Wonderful. My pleasure.
Great. And we're not seeing any more questions pop in.
Okay.
A few more thank yous. So I appreciate everyone tuning in. If you missed some of it, we did record the session, so we will have that replay available probably right away. So you can use the same link for that. So, and as I'm rambling on, we got one last question. The question came in, withholding tax. Do you recommend withholding tax on CPP and OAS to help mitigate tax surprises?
I do recommend doing something. Now, again, depends on what all your different income sources are. There are options to perhaps take extra off other things like RSP or RRIF withdrawals, which really accomplishes the same thing, right? We want to look at all your different income sources. And if your average tax rate is, let's say, 20%, well, perhaps you want 20% taken off everything. Okay. Or if you're getting nothing off CPP and OAS, but you're having 30% taken off of other income sources, it's how does that all balance out in the end? Okay. So if you're not sure what applies to you, certainly, double check with your accountant or tax professional. Find out what might make the most sense from a withholding tax standpoint. And of course, you can always play with it, right? Start with, 10 or 20% across the board based on, again, what your tax situation might look like. And you can always adjust it for future years. I'm sure they wouldn't appreciate if you called them every month making a change, nor would they probably process the first change by the time you call for the second one. But again, those would be things that you want to look at.
I can tell you from working with clientele with many retirees, a common thought is usually they kind of find the number that works, and it might take a year or two to find the number that works. Say it's 20%, 25%, and then they just do that across the board. take 25 off of CPP,
Right.
25 off of OAS. The RRIF withdrawals 25, so that way they know they're covered and it's nice and simple. But it might take a year or two to get that number fine-tuned, as you have to live retirement a little bit to really get to those exact figures. And we got
Get
one
in
more
that
question.
retirement groove.
Yes.
Exactly. Find that routine. And one more
That's the
question
best.
came in here. If I start my OAS and delay my CPP, will my CPP automatically start at 70, or do I need to apply? So a logistics question there for CPP.
I believe they've changed it now, so it will automatically start at age 70 because that is the max deferral time period. However, I'd have to fact check that statement.
Yeah, I'm on the same boat. I think
Yeah,
it's automatic.
that's what I was thinking.
They changed that like a year or two ago. I feel like they've changed that to auto start essentially at age 70 because that's the max time you can defer it.
Yeah. Okay. Good questions. I appreciate everyone tuning in, asking some questions as we go. And if there is something that comes up afterwards, of course, you can contact us directly, or you can go to chatwithclintonkevin.com. Take care, everybody.
Take care.